Why banks love credit card debt and how it traps Americans. Banks make money even when you don't, and credit card debt is their favorite way to do it. In the United States, over 170 million Americans have at least one credit card. Most people think credit cards are just a convenient way to pay. But behind the scenes, banks have built an entire system designed to profit from one thing: credit card debt. Today, we're breaking down why banks love credit card debt, how the system actually works, and what most Americans don't realize they're paying for. Let's start with a very normal situation. You live in the U.S. You earn about $60,000 a year, close to the American average. You use a credit card for groceries, gas, online shopping, maybe a few subscriptions. 1 month, an emergency happens. You don't pay the full balance. Your card balance is now $1,000. The bank tells you, "Don't worry, just pay the minimum payment." That minimum payment might be $25. It sounds manageable, harmless even, but this is exactly where banks start winning. Credit cards don't make banks rich because people use them. They make banks rich because people carry balances. Most credit cards in the U.S. have an interest rate between 18% and 29% APR. APR means annual percentage rate, how much interest you're charged per year. But here's the trick. Interest is calculated daily, not yearly. That means every single day you carry debt, interest is quietly being added. And the bank doesn't need you to miss payments. They just need you to not pay in full. Let's look at real numbers. You owe $1,000 on a credit card. Your interest rate is 24% APR. That sounds like a yearly number. But in reality, that's about 2% every month. Now the bank tells you not to worry. They say, just pay the minimum payment. So you do. In month 1, you pay $25. At the same time, about $20 in interest is added. Your balance barely moves. Month after month, the same thing happens. You keep paying, but the debt stays almost the same. If you do this long enough, something surprising happens. You can end up paying $2,000 or more just to clear a $1,000 purchase. The bank didn't sell you anything extra. They didn't raise your limit. They just waited. This is why minimum payments exist, not to help you, but to keep you in debt as long as possible. From a bank's perspective, the best customer is not someone who never pays, and it's not someone who completely defaults either. Both of those customers are problems. The perfect customer is someone very specific, someone who always pays on time, never misses a due date, and never causes trouble. But at the same time, they never pay the full balance. They carry a balance month after month. Sometimes for years, that person quietly pays interest, picks up small fees, and never triggers any risk alerts at the bank. No collections, no warnings, no red flags, late fees, interest charges, balance transfer fees. They all stack up slowly, almost invisibly. And when you zoom out, the numbers get huge. In fact, U.S. banks earn tens of billions of dollars every single year from credit card interest alone. This is exactly why credit card companies spend billions on rewards, cashback, travel points, sign-up bonuses. They're not being generous. They know that most people won't beat the math. Let's talk about rewards, cashback, points, miles. On the surface, it feels like the bank is giving you money, like you're being rewarded just for spending. It almost feels smart, like you're winning. But here's what most people don't realize. Rewards don't come from the bank's generosity. They're funded by the system itself, by interest paid by people in debt, by merchant fees charged to businesses, and by customers who don't pay their balance in full. If you carry a balance, your 2% cash back sounds good, but it quickly becomes meaningless. When you're paying 20% interest on that same purchase, you're earning a little while quietly losing much more. This is why banks love rewards programs. They encourage more spending, more swiping, and more balances carried forward. And the more you swipe, the more opportunities banks have to profit from interest and fees. Rewards don't beat the math. They just make the math easier to ignore. Let's compare two very different credit card users. Two people, the same credit card, the same rewards program. Person A pays the full balance every single month. No exceptions. They pay zero interest. They collect rewards, and they move on. From the bank's point of view, Person A actually costs money. Now look at Person B. Person B only pays the minimum. They carry a balance from month to month, and over time, they pay interest, sometimes for years. Person B doesn't miss payments. They don't cause problems. They just keep the balance alive, and that makes all the difference. Person A uses the product, but Person B is the business model. Banks don't need one or two people like Person B. They need millions of them, millions of steady balances, millions of interest payments, month after month. That's why credit card debt is so valuable, not because people spend, but because they don't pay it off. Here's what to understand. 1. Credit cards are not evil. 2. Credit card debt is where banks profit. 3. Minimum payments are designed to trap time, not help. 4. Interest grows quietly, daily. 5. Rewards don't matter if you carry a balance. Credit cards reward discipline and punish convenience. If you want money, banks, and investing explained simply, without hype or confusion, subscribe to Cash Understood. And let me know, what city are you watching from right now? If this video helped you understand money a little better, give it a like and rate it out of 10 in the comments. Because once you understand how cash really works, you stop working against yourself. Thanks for watching.